Welcome to the Africa 2100 podcast, the show where we explore the future of business, innovation, and entrepreneurship on the continent. Join us as we dive into real stories, expert insights, and practical strategies to help you build, scale, and succeed. Whether you're a founder, investor, or changemaker, this is your go-to space for ideas that shape the next generation of African businesses. Let's get started.
Joining us today are Dr. Claude Adam Callery, an entrepreneur, educator, and business consultant. He's the founder of Sagesse Lumiere, LLC. He's also a strategic partner of Africa 2100. And we also have Michael Mengo, a member of Africa 2100's Pilots FRP cohort, as well as the founder of Soleil Energy, that has an innovative cooking solution. Welcome, gentlemen. Let's get into it. So I will start off with you, Adam. When one thinks about bootstrapping, how would you describe that? What is bootstrapping?
I think bootstrapping, I know we're talking about finance, but ultimately it starts with the initial passion that most entrepreneurs have. It's the driving force that allows them to get up in the morning and they say, I'm going to take this idea and I'm going to make something out of it. In many cases, you haven't even thought about the real costs for starting this business, starting this concept. And that bootstrapping really is those initial checks that you write. It's the initial charges you put on the credit card just to get things going. It could be as simple as, I want to get a business card, or I need to get some stationery. I need to at least pay for the license, or I need to pay for what other administrative legal documentation that I need to make my business legitimate. I need to pay for marketing, whether it's social media, whether it's radio, television. I just want to get the name out there. And so that initial bootstrapping is really, what dollars do I have in the bank to get going? What room do I have on my credit card to make it happen? What family member can I turn to just to get a couple of dollars? Just get a couple of dollars. Because in reality, I think if you thought about the real cost to get things going, you probably would say, I'm not going to start this business at all. I'm just not going to do it because it's going to be too much money to accumulate. It's going to take me too long to get it going. And by the time I get the money that I need, some other person's going to come up with the idea. So I think the one thing that's beautiful about it, since we're talking about bootstrapping, that phrase, is that it really is tied to your heart. It's tied to this desire. It's tied to this passion. It ties to the fact that you say, I can get this done at all cost. At all cost. Now, from a textbook standpoint, of course, it means that I really should sit down and write a business plan, and I really should sit down and figure out my total budget. And I really need to make sure I add up all the numbers and do all the research and talk to everyone I could about what it's going to take to get the business started. But I've met too many people where that isn't done that way. Even when I started just in real estate. I wanted to do property management. So my dream was very simple, that I wanted to essentially have 30 units under my management, 30 units, so 30 apartments. And I thought I could do that using simple logic, which is I would buy 6 flats. So if I could accumulate 5-6 flats over a period of time, I would then have my 30 units. And I now would be a property manager. And I figure there'll be enough revenue being generated from those 30 units to do quite well. Now, in hindsight, that was probably a $3 million investment when I think about it. Even more than that when I think about the cost of buying the buildings. But at that moment, I wasn't worried about that. I was just thinking about that first building. And I knew I needed to get a loan to do that. And I knew I needed to fill out an application to do that. And I figured once I get the building up and running, I could sort of back into how much it would cost to manage the building in terms of janitorial service and paying the gas. But I knew I calculated how much the rent was going to be. I figured I could get it off the ground and make it happen. And I did that. In hindsight, I probably could have slowed it down a little bit. But I know I'm giving you a long answer to the question. But at the moment, it was just the feeling of being able to get this ideal off the ground that excited me so much. But I didn't want to take the time necessarily to wait for the perfect answer. I just wanted to move forward. And that's what I think of bootstrapping. It's really that desire to move forward quickly to see if I can make this dream become a reality.
So most times, most of the entrepreneurs I run into, they always believe I need funding, I need external funding, I need capital to start my business idea. And given what you just said, Adam, the question becomes, can you actually start a business without getting external funding? What do you think about that, Michael? What's been your experience?
Uh, when you ask, that's a very loaded question because when I did start, I had to get some money from here and there, especially just getting the idea off the ground. I needed to have, especially because due to the product being so visual, I needed to have something to show an investor or a potential seed funder so that they could understand the idea of where we were going. So you definitely need something, not a lot most times, but sometimes you may. But I just think it's important to have something to start with.
So you say something. Something could fall under the umbrella of bootstrapping, because by virtue of what Adam just shared with us, bootstrapping is using your own resources. At best, the resources of your friends and family, whether you're taking loans or money from them without obtaining external funding. Or is it something as it relates to external funding outside of your immediate circles? That's people who you don't know, people who you need to go solicit beyond your inner circle or yourself or tapping into your own resource. So which are you referring to when you say you need something?
Okay, I like using my own personal example to illustrate. For me, what actually helped me a lot was I did have some savings here and there. During the time when I started the business, I was going through definitely a big health scare, and it was quite frightening. So I was limited into what I could do, but I definitely got some money from my savings. I got some money from small gigs. I used to wait at hotels, restaurants, so I would get some money from there. So I did borrow from my parents a little bit. So it's the little money here and there, and then you put it together and you use that to start. So that's what I'm referencing when I do mention that.
Uh, that's helpful. Helps my understanding. So it falls under the umbrella of bootstrapping, as Adam just described. Bootstrapping. Adam, what are the common types of external funding? Let's assume I don't have anything, or I've already cleaned out my savings, but I still don't have my prototype. I still don't have something viable to take to my customers. What options do I have? Or even, let's assume I've even gotten to that stage. I've taken it as far as I can with what is referred to as bootstrapping of friends, family, and fools around, which are those who know you and are willing to give you anything you ask for without looking at what you have to offer, your services or your product. What options exist out there for external funding to raise additional money?
Well, Chudi, you've now backed me into the proverbial corner. The way you answer that, way you ask the question, I really don't have many more resources. And in fact, I'm going to go back to the question you asked Michael. When we talk about starting the business and the fact that many entrepreneurs believe they need money to start, the ultimate answer to that question is yes, you do. You need money. So even when I was giving the answer earlier and I was talking about, being driven by the passion and the dream, you do need some money to get started. So let's start there. I think the one challenge we have as entrepreneurs in the general population is that I don't think we understand venture capital funding. So let's go back to the original question. The question is, okay, what choices do I have in terms of financing? And when we think about that question, we are literally thinking, I have investors out there and I have these people called venture capitalists. And of course, they're just sitting on pools of money. And all I have to do is do a pitch and they will give me the money. And I think that's a false reality. The reality is that a venture capitalist, an investor, is really no different than a banker. They're going to have criteria that they have outlined that's going to determine whether or not they're going to give you money. And why that's important to understand is that when I start the business, I typically don't have many assets. I typically haven't generated revenue long enough to say I have a viable business. And those two things are the key criteria for funding. So whether I go to a bank or I go to an investor or I go to a venture capitalist, they're going to be looking at me and ask, well, how long have you been in business? What is the strength of your revenues? Sometimes they'll ask you what the quality of your revenues are, meaning who's providing those revenues to you. Are they solid customers that are repeat buyers? Do you have a contract with Amazon and it's a long-term contract? What's the quality? How do we know that these revenues are going to be dependable for the next 2 or 3 years? Because I have to get my money back as an investor, as a creditor. And so they're going to ask about the quality of your revenues. They're going to be asking about the longevity of your revenues. And what they're actually saying to you is that you need to be in business for some time. So the true element here in financing is not whether or not I can go out to the venture capitalist, an investor, or the banker. It's whether or not I can run the business well enough to generate revenue in order to sustain the business. And I think we have to start having that discussion with entrepreneurs. The way you framed it, Chudi, is you said, what if I run out of all my resources? I've gone to the family, I've tapped them out. I've gone to my friends and I've tapped them out. I've gone to my bank account and I've tapped them out. What you are telling me is that the business is not generating enough revenue, because the number one source of funding when you are a startup and you're transitioning to what we now call an emerging business is that you're self-sustainable. The business is generating enough revenue to cover your costs and to generate at least a profit. It may not be a comfortable profit, but a profit, because ultimately that's what the investors are going to be asking you. Are you profitable? That's what the bank is going to ask you. Are you profitable? That's what the VC is going to ask you. Are you profitable? And so until you get to that stage, it's going to be difficult to get funding. And then you may say, Adam, well, what does that mean? As a leader of my organization, it means that I need to manage the business with that in mind. I'm trying to generate profit as soon as possible. It may mean I can't grow the business as quickly as I would like to. I may have to grow it slowly. I may have to take small steps at first so I can learn what the cost drivers are, so I can learn what the revenue challenges are going to be. And then after I get into a rhythm and I start to learn from those experiences, now the business starts to perform. The revenue starts to grow. I'm covering my costs, not only a little bit, but a lot. And now I'm starting to see that profitability. And now I'm in position to start asking financiers to come in and join me in the discussion of how do we continue to keep this business growing. Again, a longer answer to your question, but I think you cannot drive the business to zero or drive the business to negative losses and then say, oh, where can I get more money from? No one's going to fund you in that scenario.
It's very insightful thinking about. So it's really being in a position to win the trust of those who have the money outside of your close confidence or your close associates, and earning that's right to do so. How does this tie into your journey, Michael? How does that relate to where you are in your journey, and what sources have you tried to solicit funding from?
Yeah, I've definitely tapped out the FFF factor, so that's out of the question at this point. So, what I've been doing, and again, this goes back to the whole thing of my product being a very, very visual product. It needs to actually be shown to someone for them to get it. So, being pre-revenue, one of the things I'm definitely exploring is grants. Grants seem to be one of the easiest ways. They're not exactly perfect, but they seem to be the easiest ways, I think, virtually that I could use to actually get to past prototype stage, get to minimum viable product, and possibly get customers on board. So I have been exploring those grant opportunities. There's several in the country, but the catch-22 situation is that you need to have a prototype to actually get the funding. So you have to basically the horse before the cart kind of situation. So you have to have something to show them for them to finally believe or put that little bit of trust in you and give you the money to, or the funding or the equipment to get to stage 2.
And Chudi, if I may just add to what Michael said, I think, Michael, you hit on a very good point. A lot more people are talking about grant opportunities here in the United States. A lot of those grants come out of the federal government, state governments, and of course, as you know, things are sort of topsy-turvy right now, but grants are a nice viable option. Also, crowdfunding is another option too. Crowdfunding allows you to at least have an idea that may be pre-revenue, but you can get it out to the general public. If your narrative is compelling enough, if the idea seems like it will catch, then that can also provide you some initial funding to continue to build out your prototype, continue to prepare you as you move through launch, the actual execution of your business plan. So crowdfunding is a possibility as well.
So, Adam, you gave us initial criteria or minimum criteria that one should consider when trying to seek external funding. You talked about, do you have a viable business? Do you have revenues? Are there other things when an entrepreneur is trying to determine, do I continue to bootstrap this or should I go seek external funding?
So I think the other criteria is the other C word. As we started this discussion, we were talking about most entrepreneurs say I have a need for capital. Mm-hmm. The other C word is capacity. And I think we don't have a discussion around that enough. Capacity means that, do I have the ability to expand what I'm currently doing? Can I actually achieve higher revenue? So for instance, I need to go out and get a bank loan. And that bank loan is going to have an interest payment, principal payment I have to make. When I add that cost to my budget, now I'm just barely breaking even. And so what I need to do, of course, is grow revenues so I can get to a higher level of profitability, so I can start making more money with the company. The question is, do I have the ability to do that? Do I have enough people working for me? Do I have the time to be able to put into the business in order to do that? So I think part of the exercise of deciding that I want to grow the business, I want to expand the business, is also understanding what it will take to achieve that higher level of revenue, that higher level of volume. And I have to consider that before I move forward and sort of apply for additional funding, before I decide I want to go before a venture capitalist. Because they're going to ask that question. When you look at what they're desiring, they're not investing in your business as it is today. In their mind, they're looking at your business to be 2 times, 3 times, even 4 times bigger than it is today, if they're going to consider giving you the money. And so they're going to be looking at you to decide whether or not you have the capacity to do that. Do you have the skills? Do you have the patience? Do you have the management ability to bring more people into your organization, to have more employees working for you, to be able to manage those employees? And it's like looking at a crystal ball. They don't know for sure. All they can do is sort of ask you questions and get a sense of whether or not you know the right answers, or you have the right temperament, or you seem to understand the industry well enough. And so I think you also have to have this understanding of capacity, how to develop capacity, how to grow capacity if you're going to start to enter this new area of financing with this category of investors. As opposed when you're bootstrapping, you're really, again, just dealing with friends, family, and yourself. And they're believing and hoping in you, and they're not asking those questions around capacity as senior finance people would do. That's what I'll share with you.
So listen to you talk about venture capitalists. They seem to be at the top of the food chain, meaning the toughest to get to because they want the pound of flesh or the pint of blood to make sure they get their money back. Then at the bottom, you have the bootstrapping, which is easier access. Are there things in between, the angel investors, the banks, crowdsourcing, funding? Could you talk a little bit about that, Adam? When you talk about the rigor, the requirements, how do they rank across all of those entities?
So how do they rank? So when your pre-revenue is, as Michael mentioned earlier, pre-revenue is this you. And that's pure bootstrapping. I haven't proven the concept yet. I'm trying to get the idea out there, and I'm trying to get followers. So I'm paying for that out of pocket. Credit card, 401k or retirement plans. I'm going to friends and family, and you can find a lot of this. There's beautiful graphs out there that show you this on the internet. But in short, what it's saying is that when I'm pre-revenue, I'm on my own. I get to a certain level though, just like when I want to buy a car, I'm making enough income where now I can afford the car note. So the same thing happens when I go to the bank, and the bank is going to be the next stage. The bank is going to say to you, okay, let me take a look at your revenues. Can you cover the debt service? Can you cover the principal and interest payment? And of course, you'll argue, yes, I can. Hopefully you have the proof of that. And the bank is going to be looking at, again, quality of your revenue, revenue again being consistency of it, and is it growing? They're going to ask you another question that people don't tend to know. If you're in a particular industry, they're going to ask you questions about that industry just to see if you understand how your competitors are operating around you. They're very simple questions, but they'll just ask you, do you know who your competitors are? Do you know what products and services they're selling? Do you know how their products differ from yours? Very simple questions, but you'll be surprised how many people just don't know. They don't know who their competitors are. They don't know how their product is competing against their competitor. They'll say, well, I'm competing on price. That's not what the bank is asking for. They're asking, do you know who you're selling to? Do you know why people are buying from you? Do you know why they're buying from your competitors? And they want to hear answers to those sorts of questions. So the next stage will be the bank. So we go from me and my family to the bank. When we leave from the bank, that's when we start getting into these other individuals that we talk about, angel investors, venture capital firms. An angel investor is someone who is independently wealthy, and you happen maybe to meet them at a social or a reception. They take a fancy to you. They think they like what you're doing. They like your idea, and they decide to personally invest in you. Venture capitalists are at the next level, at the top tier level, because what they're doing is they're investing in not just your company, but many other companies at the same time. A venture capitalist, though, unlike a bank, is going to want to have ownership in your business. They're going to want to sit around the table with you and not only help you make decisions, influence your decisions, because they're trying to get to a certain level or trying to get your business to a certain level so they can cash out. And so they already have their ideas and thoughts about how to run your business. And you're going to have to find a way of sort of have almost like a tug of war to make sure you don't lose full control of your business while you're going through this period with them until you can pay them out. So what happens with a venture capitalist, eventually you're going to buy them out so that you can retain your ownership. With a bank doesn't seek ownership. All the bank is seeking is the payment of their loan. As long as you can pay the loan back, you can run the business as you wish. They're not going to get involved in the management of your business. But as you move up that stair step, and you start to get into angel and venture capital in particular, they're going to want ownership. And what that means is that they will also want to sit around a table and have a intimate relationship with you as it comes to running your business. And that's the order. That's the pecking order. So from you investing yourself and family investing to the bank, from the bank to angel investors, then to venture capital.
Wonderful. That's clear as mud, Adam. Thanks. With that in mind, Michael, what do you say your long-term strategy is as it relates to financing and obtaining the funding that you need to keep your business going?
And Chudi, I think you're a mind reader, because that's where my thoughts were roaming right now. I was like, what am I going to do after this? So at this point, what we're focusing on mostly, of course, is to get the prototype done, and I'm hoping that'll be done before the end of this month. Then once we've done that, step 2 would be to go for the grants, get some financing just to get a few units ready, start selling, get revenue from that, reinvest back into the business, and grow from there into new markets. But my ultimate goal with this business, other than just the primary goal, which is to make energy accessible and affordable, is definitely to be bought out. I would love someone to walk over to me with $1 billion check and tell me, you know what, we like your business, we would love to buy you out, and maybe you'll give you some stock options. And that definitely is my long-term plan with my business.
Hey, Judy, I just wanted to say something based on what Michael just mentioned. And that's one thing we haven't talked about is the nature of the product or service that you're selling. So as I hear Michael speak, he's talking about prototypes. And if I have a product where it is more of a manufactured type of product, path he's talking about is a path where you can reach out a little bit earlier to investors and to venture capital, especially if it's something that has to be built. It's something that's going to be unique to that industry. It has, great potential. And then people want to join earlier on in the process. Because as I was talking earlier, I said you have the bank and then you move to the investors. If you have a physical product, something that has to be built and showcased, then you can approach investors earlier if you think this is something that has great potential. Because he said his exit strategy is to be bought out. He wants $1 billion check. So in my mind, I'm thinking that's a product that has great, will have great potential to be used by many, many, many people across a broad spectrum of locations. And so something that big, you can talk to investors much earlier on in the process if they also believe in that concept and they also believe in the potential of that concept. So you don't have to go to the bank first. Then you definitely are looking for investors to help you build out this prototype and get them on early. And then you're not even worried about having them be part of the ownership team, because maybe part of the reason why you're going to these investors is that they have background in the industry that you're trying to penetrate, and they have contacts that are going to be important to you down the road.
I've heard, and I'm looking to you, Adam, to validate. I've heard that most investors are reticent about investing in capital items, land, equipment, machinery. Can you speak to that?
When we get to the venture capital level, the venture capitalist has already decided what industries they're going to invest in. So that goes a little bit to your question. If they decide, in fact, I'm going to be honest with you, you'll hear people say, I will not invest in restaurants, period, end of statement. And you can be an established chef who's well recognized, who's won awards, but the venture capital firm that you may be approaching will not invest in restaurants. And it's not because they don't like you, it's that they know the restaurant business in general has very low profit margins. No matter how big the chain is, no matter how many franchise locations they have, the margins are very, very thin. They're very small. And so they're worried about that. Plus, in the restaurant industry, it is highly competitive and is driven by consumer trends and taste. So one day everybody's eating Caribbean food, the next day they're switching to North Korean food. and they do it overnight. They switch quickly. And so you may be on the wrong end of that transition. And so what they will invest in, though, they'll invest in what we call like clothing items or things that can be sold on a unit basis. So I can sell a lot of these things. So you'll find investors may be very comfortable. I'm drinking a bottle of water right now. So they'll invest in the water business because why? People like myself drink a lot of water. We drink a lot of these bottled waters and we buy millions of these. And they can quickly do a calculation and say, well, if I sell 1 million bottles of these, that's $10 million. Oh, yeah, I like that. So it's an easy business. They understand it. It's tied to direct sales, and they'll invest in that. So where I'm going with that is that certain firms may have certain niches that they prefer over others. Some may, again, like manufacturing, I'm talking about the investor again. Some may be comfortable in a retail space like apparel stores, maybe even restaurants. Some may or may not be interested in service businesses. Because again, service businesses are very unique. Service businesses can have a very, very high profit margin depending on what you're doing. Like consulting can be very, very high. In other cases, if I have a spa or a hair salon, margins could be very narrow, very thin, and they may not invest in those. So it is driven by the interest of the investor, which category of investments they're comfortable with. To answer your question, Chudi.
Thank you, Adam. Today's conversation has given us insights into the realities of bootstrapping and fundraising. Whether you choose to bootstrap, seek external funding, or take a hybrid approach, the key is to align your financing strategy with your business goals and growth. Funding is not the first step. As you heard Adam say, validating your business model and testing market demand should come first. Bootstrapping allows us to have more control and operational discipline, even though it comes with some financial limitations. External funding certainly needs or allows us to scale rapidly. But of course, it's a trade-off because you give up some of the ownership, as Adam mentioned earlier on. They will sit at the table with you. They will it now becomes that tug of war between you and them to get that alignment in objectives or how you run the company. You trade off for that money, you trade off some ownership of your venture. So it comes down to choosing the right approach depending on the nature of your business. It comes down to identifying what is the right time to take external funding in exchange for accelerating your business. A big thank you to both Adam and Dr. Claude Adam Callery and Michael Mengo.
Michael, you don't know why he keeps doing this to me. He's teasing me now.
That's it for today's episode of the Africa 2100 podcast. If you found value in this conversation, share it with someone who needs to hear it. And don't forget to subscribe so you never miss an episode. For more insights on building and scaling your startup, stay connected with us. Until next time, keep innovating, keep building, and let's shape the future of African business.